Hello everybody. Today we're going to talk about retirement accounts. I know a lot of people have questions about all the different retirement accounts out there and what they mean, so we're just going to jump into it and walk through some of those today. As always, please treat this information as informational only and don't consider it any type of advice. So the question of the day, what do you need to know about retirement accounts? So the big things we need to know are the type of the accounts, what are out there, and kind of what their nuances are. And then we're going to compare some Roth and traditional. Those probably are two terms that people are very familiar with hearing, but a lot of people don't understand. So we'll try to make that simple for you guys. So the types of accounts, there is many out there. So 401k, 403b, IRAs, HSAs. So in general, these are all retirement accounts. 401k, 403b are very similar depending on what type of organization you work for. They're an employee-sponsored or employer-sponsored retirement account. So if you work for a nonprofit or a corporation, you'll get one of those typically, and they might contribute to it. An IRA is an individual retirement account, so that's something that's not an employer sponsored, that you yourself can open up and put your money into it. The difference between the 401k and an IRA, not a whole lot. There's some nuanced differences, some contribution limitations, small things like that. But in general, they function kind of the same way. At that level that we're looking at, we're going to say that they function the same way, and they're pretty much the same. An HSA is something that's not as commonly considered a retirement account. So it's a health savings account. It's what we typically, or what a specific type of insurance plan will use to help you pay for healthcare costs, but it's actually kind of a retirement account because the money that you put into it is treated very favorably, and it kind of grows over time and will help you pay for healthcare in the future if you don't use it all now. So then the two big ones, traditional and Roth. So jumping back, this applies to a 401k, 403b, and IRA. All three of those can be either a traditional or a Roth. And so what does that mean? Let's just go right into it. Traditional contributions are tax deductible. Roth contributions are not tax deductible, but growth is not taxed. So hopefully that makes a little bit of sense, but let's get into it a little bit more because I'm sure some of you out there are scratching your heads at that. So let's just get an example to make it a little bit easier. In a traditional, we say you put $10,000 into it right now, and over 20 years you make 7% on that. In 20 years you're going to have $36,000 in that retirement account. Now, when Uncle Sam comes calling, two things that are absolute: death and taxes. The amount taxed when you put it in right now is 0. So if you make $100,000 and you put $10,000 away, you're actually getting $10,000 off your earnings. So instead of reporting that you have $100,000, you'll end up reporting and being taxed on $90,000 for your earnings that year. However, in 20 years, when you take that money out, you will be taxed on all $36,000 of it. So if you are at retirement and you're not making anything else, you're just going to have an income of $36,000 that year. Hopefully that makes sense, and let's jump over to the Roth example. So we're going to use the same situation. You put in $10,000, 20 years later, it's $36,000. For taxes, your amount taxed is going to be $10,000. So if you made $100,000, put $10,000 into a Roth, you're still going to have an income of $100,000 that year, and you'll be taxed on that in total. But then at the end, when retirement comes and you pull out that $36,000, the amount taxed is 0. So if you still make nothing and you pull out $36,000, you're going to end up reporting that you have an income of 0. So as you can see, the growth is not taxed, and that could be a huge benefit for you. So the big differences between them, in traditional, it reduces your income now, and you pay taxes on the investment and growth at the end. In the Roth, you pay taxes now on your contribution, and at the end, nothing is taxed. So the growth is totally tax-free. So some of the pros and cons of the traditional. The pros, you have more money when you're starting out in life. Typically, when people are first starting their careers, that's when they're starting a family, buying a house, getting everything settled, and that's when you typically need money. So traditional accounts were designed in a way that it gives you money now and kind of tries to spread out your earnings into your lesser earning years, which is typically your retirement. So all taxes are deferred until you begin withdrawing funds. So there is some control over that. You can kind of control when you're going to be taxed on that. The cons, if you withdraw money before you're 59 and a half, you pay a penalty on it. So typically it's not a very good idea to withdraw money before you're 59 and a half. So that money is kind of locked away until you're almost 60. And you cannot contribute if over 70 and a half years old. Not a huge issue. Most people aren't contributing money when they're over 70 to a retirement account anyways, but it's a small con nonetheless. Jumping over to the Roth, the pros, all growth is tax-free. So if you're young and you are investing in a Roth, by the time 20, 30 years rolls around and you get ready to retire, that money can grow quite substantially. We talked about some compound interest in another video, and you can see the power beyond that. You can withdraw your investment without penalty. So this is a huge pro. Like we talked about, a con for the traditional is that there's a penalty if you withdraw it before 59. Since you've already been taxed on this money, you can withdraw it. Now, this is just your contributions, not the growth. So if you put in our example, you could withdraw that $10,000 at any time you want. And there wouldn't be a penalty on it. There's also no age restriction. Once again, not a huge difference between them, but if you're 70 years old and for some reason just got a really good job and don't want to retire for a while, you could contribute to a Roth. The cons, kind of the same thing as the traditional. If you withdraw the growth before you're 60 years old, there's a penalty with that. So you can get out your investment without any penalty, but if you withdraw any growth, then there is a penalty on that, similar to the traditional. And then the other con is that you have less money when you're starting out in life. So like we talked about with the traditional, where you want more money at first as you're starting a family, buying a house, there's less money of it going around because you're getting taxed on it. So hopefully that made it a little bit simpler for you guys. Some things to consider on this, other videos that might be of interest to you. There's not a clear-cut answer for everything. There's pros and cons for both of these. It's really up to what you have in your financial plan. In general, you can say that if you have a lot of time to contribute money, a Roth makes sense. You can't go wrong with it. It's not a bad choice. And if you have a lot of income right now and you're kind of seeing that going to trail off, a traditional is definitely not a bad choice. So it kind of depends on the person, their situation. It makes sense to talk to somebody who's an expert in the area and knows your particular situation to kind of get their advice and feedback, and hopefully you guys will be a little bit better informed when you talk to them now. Thanks.